Back, everyone. It's Brian Strain here. We're doing the Hurley Investments Market View commentary. Today is May the 18th, and so we had a recording issue. We did this session last night, and for some reason, with the new interface, we didn't get the session recorded. So I'm revisiting and recording this information so that those who couldn't attend last night can watch, and others can review. So a lot of new headlines have been coming up talking about overvalued stocks, especially AI stocks. I grabbed a couple of headlines from different news sources uh, just to illustrate. This was just from yesterday. Um, had there were actually quite a bit more than that. And a couple of weeks ago, Kevin talked a little bit about valuation and talking about, when how stocks can go, they can be at new highs. They kind of get flat a little bit sometimes when they're pushing new highs, and then they rise. And there was a few things that his session prompted me that made me want to talk about our current market conditions. You've probably seen some headlines along the lines, of talking about fear of inflation. If you thought the word inflation is a dirty word as an investor, you're not alone. But there is a misconception about inflation. So I want to ask a question real quick. Many investors think that inflation is bad for the stock market. Is that true? Um, a lot of investors, we hear the word inflation. It's a dirty word. It's something we don't want to know. We don't want to see. We we're worried about it when we hear that inflation is bad. Is that true? I really want you to think about this. Um, if we go back, and you guys have been through a lot of our education process in the past, and you can get videos. If you haven't seen them already, you can go back to My Hurley Investments and watch old videos. But we've talked a lot about how we evaluate stocks, and we make sure, and how we do our fundamental analysis. And when we get into fundamental analysis, we're looking at earnings gains, we're looking at PE ratios, we're looking at all these different things. Stocks, their value tends to increase because of their earnings, right? The company is profitable. They're making earnings, they're getting good earnings, and if they get good earnings, the stock price tends to rise. Think about this. If the prices of goods and services are inflating, then so are corporate earnings. If corporate earnings are inflating, then it's also likely that the stock prices are inflating. So if inflation is running rampant, we should see stock prices also inflate. So inflation in and of itself is actually good for the stock market. Stock prices tend to go up quickly when inflation is rampant. So why is inflation such a dirty word? Well, it devalues our currency, right? If things cost more, if I used to go to the store, I remember when I was a kid, I used to go to the store and buy a full size Snicker bar for a quarter, and now they're $2, right? That's inflation. Um, the value of my dollar is less now than it was when I was a kid. I can't buy as much. That's inflation. It devalues our currency. Now, if you know this, you also need to know that the FOMC, or the Federal Open Market Committee, has the job to protect our currency. That's one of their mandates. They need to protect the value of our currency. And they have a dual mandate. They also need to maintain maximum employment. So they've got a dual mandate, and they've got a balancing act that they need to do. Inflation is natural. Stock prices tend to go up over time, and there's an acceptable rate of inflation that the Fed is always pointing to. they want things to inflate at 2% per year, right? That's what their target inflation rate is, 2%. So they want things to inflate over time, and it's a sign that the economy is doing well if prices are going up. Now, the problem is that if inflation is running rampant, wages and salary is the last thing to catch up, right? So if the prices of candy bars and gasoline and everything else is higher, the cost of living is higher, our salaries need to keep up. And so if you have people that are, if you're an employee and you work for a good company, and inflation is 2% every year, then you would expect, and good companies do this, they offer a 2% raise. They call it cost of living increase, right? They typically give you a raise for a cost of living increase. So if inflation is at 2% and your raises, your salaries at 2%, we're in a healthy situation. That's great. The problem is when things are inflating at 10 or 20% and wages are only growing at 2%, that's really difficult. That's not sustainable. So the Fed has the job of taming inflation to make sure that it doesn't outrun our ability to afford costs of living, right? They protect our currency. And so it's their job to tame inflation. So how do they do this? They they do one thing really, really well, right? They have a few tools, but they have a primary tool that they use, and that is they control the shortest term interest rate, the Fed funds rate, the overnight loan rate. So let's just talk a little bit about banks. How do they make money? They borrow at short-term overnight rates. They borrow from the Fed at the Fed funds rate, which is typically low, and they loan at longer terms. So the longer terms tend to have higher interest rates. Now, we tend to measure this. The difference between those interest rates is the profit margin for the banks, and it's called. We measure it using a tool called the yield curve. And this is what a normal yield curve looks like. Now, this yield curve doesn't have the Fed funds rate on it. It's got the 3 month, 5 year, 10 year, 20 year, and 30 year. So banks are trying to they're borrowing at a rate that's not on this chart over here, the Fed funds rate, when they borrow from the from the Federal Reserve. I actually used to work at a bank. That the bank was First Security Bank. It was purchased. The company was bought by Wells Fargo. I used to work in their main vault, and I stood between the bank and the Federal Reserve. So I received cash from the Federal Reserve and sent deposits back to the Federal Reserve, and so it was a really fun job. It was interesting. I've been in that role where I stood between the banks and the Federal Reserve and saw the money going back and forth. Now, this yield curve, banks are borrowing at this rate and they're loaning at this rate. Their profit margin is the difference between those two rates. That's how they make money. So when the Fed is, how do they tame inflation? They raise short term, or they raise that interest rate. So what happens when they raise that interest rate? It all depends, and there's a whole bunch of variables here that I'm not going to discuss. I'm just trying to get a concept into your head. Um, they what they do is they raise that short-term rate so high that we end up with an inverted yield curve. So when the short-term rates are higher than the long-term rates, what happens to bank profit margin? It's gone, right? They can't borrow at short-term rates and loan. So the 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 Federal Reserve controls absolutely what that short-term Fed funds rate is. They can dictate what that rate is, and nobody can do anything about it. But the long-term rates, the Fed doesn't have anything, they don't have any control over those long-term rates. Those long-term rates are dictated by supply and demand. And so when they raise that short-term interest rate high and the yield curve inverts, so the rest of the uh, in, you know the rest of the loan rates are more expensive. What do banks do? They stop loaning money. There's no profit in them loaning money. Their only profit is you having money in an account. They can loan it out at higher rates. But what happens when people they can't pay those higher rates? They don't want those higher rates. Then things don't happen, right? So if a business, if they want to expand or they want to grow or they want to do something, they borrow money from the banks and then they take that money and invest it into building up products or services or whatever. If they can't get access to cash, if the yield curve is inverted, banks aren't loaning money. Banks will loan money, but they only loan it when there's a profit potential involved. And if the market's not willing to pay that rate, then they can't loan money. And so it hurts the economy when the yield curve inverts. It's just people don't have access to cheap cash. Now, we've seen we've seen some stuff here recently. What happened in COVID? Uh, how does the market stimulate, right? How do they stimulate the lower interest? The Fed, when the economy's in trouble, they they lower interest rates, and they lowered them during COVID to zero. So you got free money if you want money and that's how they stimulate the market. Well, this is the opposite of that. If the yield curve inverts, this is the government saying, you know what? We're taming inflation, and that's all there is. If you go back to the days when I was a little kid and my dad was living in the house later, I learned that during Jimmy Carter's days and Volcker was the Fed chair at the time. Uh, Inflation was bad. It was even stagflation. But my dad was paying on his house an 18% interest rate. And today we think that is ridiculous. But back then, Volcker was absolutely determined he was going to tame inflation and get things back to something that's more reasonable. And so he did it. And that's how we have the doctrine that we have today. That's how we ended up with the market that we're in today. So what we're seeing right now, current market conditions, the yield curve is flattening. And what's happening is that the bond market, so right now the stock market is not worried about inflation, right? Stocks are climbing, we're hitting new highs. Even in a war situation, we're still hitting new highs. As long as it's not bad news this week, uh, we're 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 right up there. Valuations are really high. Um, Stocks are going through the roof. AI stocks, there's the big ones, Nvidia, there's Google, uh, and I want to point out too, one of the things that I wanted to point out is, oh, I didn't get it in here. Oh, anyway, I'll get back to that in a minute. Uh, anyway, the back to the yield curve. The yield curve is flattening, and some of the articles that I've been reading even today are talking about how the bond market is starting to anticipate. People are seeing that inflation is remaining high. Um, Overall inflation around 3.5%. The Fed's targets too. Inflation is sticky and high, but the bond market, they are much more concerned about inflation than the stock market because it does really impact bonds. And so the short-term bond rates are increasing, and the yield curve is very flat right now. It's flattening. It's not inverted yet. It's not inverted yet, but it is flattening, and the bond market is starting to anticipate that the Fed's next action is that they're going to raise interest rates, not lower them. That inflation is being too sticky, and they think that the Fed may take action by raising rates rather than lowering them. Now, I don't know that that's true because we all know that Trump's feelings, if you've been paying attention to the news at all and seen any comments from Trump about Jerome Powell, he wants him to lower rates, and that's inflationary. Um, and the gas prices are going up. That's inflationary. Tariffs are going, out there. That's inflationary. Those things are all inflationary, and they all help the stock market to go up. Um, and at least until the Fed is fighting it. And if the Fed starts fighting it, if the Fed's next action is to raise interest rates, and they do it to the point that we get an inverted yield curve like this right here, um, that's what's bad for the market. Yield curve inversions, when the Fed is fighting inflation, inverted yield curves are the that's that's the we are gonna that's when the Fed is saying we're gonna hurt the market. We're gonna hurt the market to save the value of our currency, to protect the value of our currency, and we don't care that stocks are taking a hit. If you go back here, these are past yield curve inversions. 2001. This is the big one, 2008 to 2009. That's when the stock market lost 57% from top to bottom. The S&P 500 lost 57%. The longer the yield curve stays inverted, the harder it is on the economy. Um, and then we had a little one here back in 2000. That didn't last very long. That was just a little blip. And so our recovery was much quicker on that one. But that's what's bad for the market is when the yield curve inverts. So if the new Fed chair who's just been confirmed, Warsh, who's replacing Powell, if he comes back and in all of his hearings, he was talking about different metrics that he was using, and Trump was putting him into place because he thinks that he'll lower rates the way Trump wants him to. If they do that, if he comes in and they lower rates, um, then that's inflationary, and inflation is good for the stock market. And one of the reasons why I really wanted to talk about this is that when we're talking about our holdings, we've got Micron, Nvidia, Google, all these different stocks. Let me pull up. Um, where's the Oh, I just had to find these real quick. Um, so this article right here is talking about Google. So you guys know we follow Warren Buffett and Berkshire Hathaway. They are value investors, and we're talking. And what Kevin was talking about recently was valuation on some of these stocks that we're in, and things going high. Wait, delete that. All right. Um, this article is talking about uh, Abel, the replacement for Warren Buffett, Greg Abel, has been selling off a bunch of assets and adding money to one of their investments in Alphabet, Google. Uh, it's Google. Let's look at a chart of Google. We're near all-time highs here, right? And he's adding money to Google. Why? Because that thing, it's an all-time highs, and it's right around all-time highs, and it still has room to grow. And especially if, you know, if the economy's healthy and it's going on, forward, they're a big AI player. There's still plenty of room to go. So their value investors are still buying Google at all-time highs, even though their market cap is huge. The tech is still there. They're still going. So how high can it go? There's no limit. There is no limit. This can go up. And when we're looking at earnings, Google, they nailed it. The last earnings report right here, uh, estimated 263. They almost doubled that from their last earnings. They almost doubled it, the expectations. So they're making money. It's profitable. The economy seems to be resilient, is doing well. That's all good news right there on that. Um, Let me get to the other one. Oh, here's how NVIDIA stock has historically performed around earnings. So we have earnings on NVIDIA um, tomorrow. Tomorrow. And this article is talking about historically how buying Nvidia before earnings, um, and measuring that different time period. After one day, it's typically up 3%, or sorry, 0.3%. After 1 week, it's typically up 3.5% roughly. After a month, it's up 0.4, so it has some pullback. After a quarter, it's usually up 11%. After a year, it's up 86. So this is telling us that buying NVIDIA um, is better to do it on the long term, but buying it before earnings is actually a good bet. And uh, just all the factors that we have going into NVIDIA, you've heard us talking about. They've got they've they've got so much demand that they're having a hard time keeping up with supply. Um, they've got orders that are going out, into next year. People are ordering already for things that haven't even been developed yet. Uh, the things that aren't even being produced yet. They're buying chips ahead of the curve, and there's no end in sight to that. With people, the demand because of AI is just going crazy. So it's still a good long-term bet. It's still carrying the market, and I expect tomorrow, when we get that earnings report, that they're going to have a beat. Now, it's never, remember the last time I spoke a couple weeks ago, the last time I was teaching, we were talking about uh, the fact that um, that these stocks, that the earnings don't matter, right? Earnings don't matter. What they've done in the past isn't what's driving the stock price higher. It's what we're expecting in the future. So yes, do I expect the earnings to blow out expectations out? I do. Does that mean the stock's going to go up? I don't know, because what's really going to be important is whatever is said in that conference call. So when the CEO speaks and starts to tell us what they're doing and how things are going and what to expect in the future, that's what's going to drive the stock higher. Um, and based on the history and based on the fundamentals of the company, it still looks like Nvidia is going to carry the S&P 500 higher. And if it does, it's going to carry all of our stuff, right? It's going to carry Micron, it'll carry Google, it'll carry all those stocks. So so that's the good news, is that's what we're looking at. So I put on here some different companies that have earnings coming up over the next couple weeks. We've got Nvidia tomorrow, Walmart on Thursday. Those are the two we'll be watching this week. Something to also remember about this week is next week is uh, um, is Memorial Day on Monday. So we'll talk about that in a minute. So, but trading might be done on Wednesday. So just pay attention. So unless something really weird happens on Thursday and Friday, most people tend to check out to have a long weekend. So we're expecting them to kind of start checking out on Wednesday. Briefing.com is the big picture, right? And I love that. So this is the topic. I came up with this topic a couple of weeks ago when Kevin was talking, and uh, now the market's catching up here in the big picture. They're talking about uh, treasury yields threatening stock valuations, because as those treasury and bonds, as those yields come up on those, they do compete with stocks. And this is something, and I highlighted risk free right here because I want you to know, even government treasuries, they're not risk free. The government can default on those those bonds, those treasuries, and companies can they can default on bonds, right? So even though they're higher probability payouts, they're not risk free. And I just wanted to make sure that you guys all know that. The markets no longer expect Fed rate cuts, and that's what I'm talking about. This is they're highlighting here that bond rates are going up, that even Fed fund rate futures are implying that people are starting to think that the next Fed move is not going to be a cut. It's going to be an increase, a raise in the interest rate. And so that's a little bit concerning. It's not happened yet, right? And with the new and whenever you get a new Fed chair, I just have to point out that every Fed chair has to learn how to talk. Now it doesn't matter how much they've been tutored by the previous chairs or by how much they've studied. They they have no idea when they get up there and speak for the first time how just a single word in the wrong place can make the market make a huge move, and they don't want to do that. They want people to behave in the way that they want them to behave in, and they try to make sure that they're not causing added volatility to the markets. So we'll see what the new Fed chair has to say, and I would expect typically their first few meetings cause some volatility because they have to learn how to speak to the public. Um, Other things that are being highlighted here, the AI boom unfolding. You might interpret the interest rates as an expression of strong economic growth. On the other hand, with recent surge in inflation, one might interpret the jump rates as an expression of inflation concerns that could ultimately give way to demand destruction and slower growth. So that's talking about the negatives potential right there. The counter argument I highlighted down here is that the stocks are still offering better return opportunity in a rising inflation environment that enables companies to raise prices and protect profit margins. So, and that's what I was talking about. So I think that's what we have going on right now, is that these stocks, especially these big AI stocks that are carrying the indexes higher, um, they they can justify the demand, right? The supply and the demand is really driving those stocks higher, and they have some justification there. Uh, but the big concern is, all else equal, lower interest rates are better for stock market than higher interest rates. But higher rates don't have to be a death knell the stock market if they are rising for good reasons, right? If the strength of the economy is growing and wages are growing along with that growth, that bodes well for earnings prospects, and that that yield curve could steepen. And by steepen, that means those longer term rates can go higher and the short term rates are lower. There's still profit margin in that for banks. There's still profit margin in that for companies, businesses, and it's not necessarily a bad thing. But if wages don't grow enough, then the Fed will raise to the point where the yield curve inverts, and that's when inflation is bad. When inflation grows so much that the Fed decides that they've got to fight it, that's when it's bad. Um, I want to get a lot of the stock market people, a lot of people, investors in the stock market are viewing inflation prints as transitory. They still think that inflation is coming down and it will normalize over time. Bonds, they're more keen on those interest rates, and they're starting to anticipate rate hikes. So the bond market is in conflict with the stock market right now on inflation fears. Um, yeah, uh, loan demand financing costs create barrier for multiple expansion. Yes, so if rates just if rates get too high, it hurts the market. There's people can't borrow, they can't expand. Where are we going to end the market this week? I'm expecting higher. I think those Nvidia earnings are going to come out. They're going to carry the market higher, carry other things. Um, we've kind of we're the Dow Jones Industrial Average is it's kind of been flat here a little bit. Same with S&P. It's been flat over the last week or so, as a little bit of gains. Same with all the big indexes, have similar patterns, but I think that they will finish the week higher. Where will it end this week? I'm expecting higher. We do have earnings. That this one we're really going to be paying attention to is Wednesday, Nvidia, and then Walmart on Thursday. Uh, I think after Walmart, I believe is after the market close. Did I put that up here? No, before the market open. So I think Wednesday, one after Nvidia on Wednesday and Walmart at the open. With the holiday next week, investors are going to start checking out after Wednesday. Data that we have coming out first 2 days of the week, our housing market, housing permits, housing stuff. Wednesday we'll have petroleum status that is affecting market, and we'll get FOMC minutes where we get to hear the different opinions of all the Fed governors who are controlling those interest rates. We get a little bit clearer idea of what's going on in their heads. But that's all I've got for this week. I hope this is helpful. Uh, the the point that I also want to make too is that if the yield curve inverts, that's a sign for us with 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 all these big stocks, right? That if the Fed is going to push the yield curve to invert, we can expect all stocks to start probably heading down. Um, and there's plenty of room in there for a good size correction. The yield curve inversion could be the trigger. We'll find out what the Fed says um, when we hear from Warsh for the first time. We'll get a better idea of what's going to happen there. If that is the trigger, we can double up on. So we're very keen on protecting our positions and making sure we don't get hurt by sudden downdrafts. But if the yield curve inverts, you can bet we're going to be putting double the number of puts on so that we can actually make money as the stocks go down. We're not just holding our own, and we're not just holding our place and our value. We want to make a profit if the stock goes down. And the benefit of our strategy of collaring our positions, if we double up on those puts, if we can get them cheap and it's easy, we can just spend and get more puts. If they're expensive, which sometimes they are, especially when the yield curve inverts and people start to get pretty uh, negative on the market, um, they can get expensive. Then we'll figure out a way to let somebody else pay for those expensive options for us, or at least reduce the cost so that we can get them cheap enough. But we can earn money on the way down like we did in 2008. So we'll be keen in on that. And so just so you guys know, we're using strategies that are safe, even if we love big moves in the market, whether they're bullish big moves, those are our favorites, but we can make money to the downside too. And if we get those if we're double protection, if we have twice as many puts as we have shares, then that can be another source of profit as the market goes down. So that's what you need to pay attention to and look for. I don't have anything else, so I'm going to let you guys go. And thank you for watching. We'll see you next time. Oh, I forgot one thing. Uh, just a reminder, next week is Memorial Day. Normally, that means we do our market commentaries on Tuesday, but we've got a lot going on. We're very busy right now. So next week, we are not going to do our market view commentary. We're just going to skip it next week. So so no need to tune in next Tuesday. We'll be back the following week on Monday. Okay. Just wanted to let you know on that. So what to expect. Uh, Thank you for watching. We'll see you next time. Bye bye.